Investing can be a great way to grow wealth and secure a comfortable financial future, but it's important to avoid common mistakes that beginners often make. In this video, we will be looking at the 6 investing mistakes that beginners often make and how you can avoid them. But before we dive into the topic, hello and welcome back to our channel, The Wealth Shack. And if you're new here, please like and subscribe. On this channel, we are helping hardworking people like you get more out of your hard-earned money by showing you how to use your money in the most effective way. With that being said, let's dive into the video. Here are 6 investing mistakes that beginners should avoid. 1. Not having a clear investment strategy. Many beginner investors jump into the market without a well-thought-out plan. Having a clear investment strategy is essential for success in investing. Having a well-thought-out plan includes identifying your investment goals, risk tolerance, and timeline for investment. Without a clear investment strategy, you may be more likely to make impulsive or poorly thought-out investment decisions. This can increase the risk of losing money and potentially result in significant financial losses. Additionally, a clear investment strategy helps you to identify and prioritize investment opportunities that align with your goals and risk tolerance. Without a strategy, you may miss out on valuable investment opportunities or invest in assets that are not well suited to your goals. 2. Chasing trends and buying past performance. Beginners often chase returns, buying into popular investments or stock market trends in hopes of making quick profits. However, this can be a risky strategy as it neglects the importance of diversification and ignores underlying market conditions. A better approach is to focus on building a well-diversified portfolio that aligns with your investment goals and risk tolerance. Past performance is not indicative of future results. Just because an asset or market performed well in the past does not mean it will continue to perform well in the future. Many factors, such as economic conditions, political events, and market sentiment, can impact investment performance. Additionally, chasing trends and buying past performance can also involve attempting to time the market, which is a notoriously difficult and unreliable strategy. Market timing is often based on speculation and guesswork, rather than a solid investment strategy. 3. Emotional investing. Emotional investing, or making investment decisions based on emotions such as fear or greed, can be a major mistake for investors. Emotional investing can lead to impulsive decisions and investments in assets or markets that may not align with your goals or risk tolerance. This can result in poor investment returns or significant financial losses. 4. Using money you can't afford to lose. When you invest money that you cannot afford to risk, your emotions and stress levels get heightened, which can lead to poor and impulsive investment decisions. When evaluating stocks, consider your risk tolerance, which is your willingness to lose a portion or all of your original investment in exchange for higher returns. When determining your risk tolerance, evaluate the securities or asset classes you're comfortable with, such as growth stocks versus bonds. Don't invest money you can't afford to lose, such as your rent money or emergency savings. Conversely, you will make much better investment decisions by investing money that you can afford to risk. 5. Not diversifying. One common mistake that many investors make is not diversifying their portfolios. When you don't diversify your portfolio, you are putting all of your eggs in one basket. This means that if one of your investments performs poorly, your entire portfolio is at risk. Diversifying helps to reduce the risk of losing a large portion of your investment if one particular asset performs poorly. Additionally, by diversifying your portfolio, it allows you to invest in a range of different assets and markets. This can provide you with access to a wider range of investment opportunities, which you may miss out on if you don't diversify. 6. Timing the market. Timing the market or attempting to make investment decisions based on short-term market movements is a common mistake made by many investors. The stock market is unpredictable, and it's impossible to know for sure when it will rise or fall. Attempting to time the market can result in missed opportunities and significant financial losses. It's not about timing the market, but about timing the market. Research shows that those who stay invested over the long run in a well-diversified portfolio will generally do better than those who try to profit from turning points in the market. By trying to time the market, investors may miss out on opportunities for growth as they wait for the perfect moment to invest. Over time, even small missed opportunities can have a significant impact on investment returns. Additionally, timing the market often involves frequent buying and selling of assets, which can result in increased transaction costs and reduce overall investment returns. To conclude, remember, investing is a long-term commitment and requires patience, discipline, and a commitment to education. By avoiding these common mistakes and focusing on building a well-diversified portfolio, you can reach your investment goals and secure a comfortable financial future. Thanks for watching. Don't forget to hit the like button and subscribe for more great content coming your way. We'll see you in the next video.